It's- Right. That's it. Okay. Yeah. Okay, so good evening, everybody. It's 6 o'clock. Sorry for the issue that we had today. My car just decided to die on me as I was coming into class tonight and can't get a rental till Monday, so I can't exactly get to campus. But we already had this Zoom set up, so I thought we'd take advantage of that. So what we got on the screen here is the overview for tonight's class. I am recording and will post the link to the MP4 to our class folder here for week 13, and it'll link out to YouTube that I use for Bradley purposes. So without further ado, we'll just go into material, and that's chapter 9. So I'll stop my video here and we'll go right to the PowerPoint. Okay, so what we're talking here is chapter 9 on pro forma or projected financial statements and financial forecasting. We talked a little bit about that last week when we discussed the business plan. This is part of submitting a business plan, is to submit financial forecasts and projected financial statements. So we get into this chapter, into the kind of the technicalities of how to do so. There are different methods to use, and we will discuss those as well. So get into a little bit of the background, what pro forma basically means, per the text. And actually, no, this wasn't per the text. Just got this on dictionary.com. It's just indicating hypothetical. These are all guesses, financial figures based on either previous business operations or just best guess. We're doing this just for estimate purposes, usually for the benefit of banks, for, the Small Business Administration, possibly municipalities, usually for the purposes of startup business funding. So that is who requires financial projections. You want to include that in your business plan, a minimum of 3 years. It's not as easy to project finances when you have, not conducted business at all in a company yet. So these will be best guesses. There are places to get like some statistics, and usually, you develop your pro forma, you get about a year of actual numbers under your belt, and then you can use those numbers to possibly project a little bit more accurately. These these projections get refined over time. So who requires the financial projections? Not only should we put that in a business plan for a 3-year period, but for funding purposes, Small Business Administration requires projections, banks and credit unions for startup funding, as well as we mentioned this during class time last week, that new businesses can also look to local municipalities, cities for potential business funding through either a city's economic development department, should the city have one, or tax increment financing district, if the city should have one as well. Peoria has both. And actually a small little town like Chillicothe, they have both as well. So pro forma still, what else we're useful for? Business valuation. If a company is someone's looking to sell their business. Also, if they're looking to attract potential investors or angel investors or venture capitalists, lenders, of course, and also for company management to, see if we have any, potential challenges inherent in the business. And also a very important part here is to determine the need for potential future borrowing. So if we can do cash flow projections and, see when the company may be light on cash, and we can plan our borrowings that way. So steps to estimate net profit. This comes right out of the textbook on the top of page 173. This is figure 9.1. Basically, you start with projecting your sales by units. How many units of product do we think we're going to be able to move, multiplied by the product price. That product is the total projected revenue. From that, we subtract our production costs, could be probably our cost of goods sold. Again, these are just estimates. So projected revenue minus projected cost of goods sold equals projected gross profit minus our projected operating costs equals our operating profit, EBIT, which is earnings before interest and taxes, minus, I love how they have interests plural. It's interest expense. So earnings before interest and taxes minus interest expense equals net profit before taxes. From that, you subtract projected income taxes, and that gives you really net income, or as it's labeled here, earnings after interest and taxes, or net profit after interest and taxes. And then it's basically just put into a financial statement format. But you do want to indicate on the face of the projected financial statement that it is projected, to make sure that this, the users understand this is not the result of actual operations, but just guesstimates. So this is a little bit more kind of an explanatory format. explanation format what we just looked at in the visual. So cost of goods sold, you would probably have some sort of an estimate as to about how much of a markup you want to do. That markup should tell you about what your projected cost of goods sold is on a per unit basis. So we would project out also things like operating costs, interest, and taxes. The interest would come from the company's projected borrowings, and you would typically do some sort of a statement of cash flows, kind of a budgeted cash flow in order to determine that amount. Excuse me. So starting point is going to be projecting our revenues. And if you're following in the PowerPoints, this would be slide 7, excuse me. So you estimate your number of units to be sold, multiply that by your expected market price of the product per unit. The result would be your total projected revenue. That is at least our starting point. And a lot of the expenses we can express as a percentage of projected revenues as well. And again, these are, excuse me, all guesses. So, especially when you're getting started up, you're not going to have any hard figures on which to base anything. So, you're going to need projections virtually everywhere for startup ventures. So, how can we come up with these figures? We can base those on past experience. If the entrepreneur has had a similar venture, or if someone in management has participated in a similar business, maybe that might serve as a basis for the projections of this new venture. We could also use any available published information for similar companies who have price information readily available. But once again, you're projecting, and then you get actual results under a year or so has lapsed and you have some actual business results to go by. You can use those to correct your projections where necessary and use those to go forward. Make sure we don't have anybody in the nope. Okay. So again, after 1 year's completed, the thing to do would be to compare the actual results to the pro forma results, identify where any bad guessing may have happened. So we would at that point determine what kind of relationships we have between the profit and loss figures, our expenses as a rough percentage of sales, and what our cost of goods sold is expressed as a percentage of sales. And we'll get better and better and better estimates going forward once we have a year at least of actual results on which to rely. So this is out of the book. Their presentation was a little bit I don't know, not so easy to read, in my opinion, on the top of page 174. So this is the table 9.1, which was a 1-year pro forma income statement showing the actual figures and projected figures. We have actual figures for the current year, projected figures for the next year. So we would kind of come up with some relationships between, maybe we were projecting a certain increase in sales revenue. Say that, let me see what the actual percentage was here. 594, 450. So it's about a 32% increase in sales revenue is what's being projected. And some, as you can see, some items did not change. Things like your salaries. Those were projected to stay the same, even though there's an increase in sales for the following year. Well, this might be management salaries. There would, of course, if there was, a product to be sold or, manufactured, this cost of production, this would be a manufactured product. There should also be salaries or, wages for your factory workers as well. And those you would expect there to be an increase. If you have an increase in sales revenue, you know, as a result of an increase in production, you should expect that your salaries for your production workers should increase as well. This problem, or this table, did not give us an expense category of wages for our production employees. Of course, those might also be included as direct labor as part of the cost of production. So that could very well be, and likely is so. Excuse me. So a little bit of an increase in utilities because maybe the company is adding a shift, producing more product. We have additional production time that's going to show up in our utility bills being higher. The increase in depreciation, company must be projecting that they're going to add some fixed assets, or potentially the current year was maybe not a full year, and maybe the projection for next year is. So rent was the same. There's probably a lease agreement that sets that amount. And they might be in a multi-year lease where the rent doesn't change from one year to the next. Increase projected in insurance, and also an increase projected in interest expense. And possibly the company's buying additional fixed assets. That may be accomplished through financing. So this company is hoping in the next year to ramp up its production. There will be additional costs, but a lot of the operating expenses will stay about flat compared to the year before. So projected, this company is possibly looking at a heck of a profit. So we would see how those figures would pair out in the next year compared with actual figures. Also, and this is adjacent in the textbook, this is top of page 175. And the top of 175 has the projected 1-year pro forma balance sheet. The first column are the actual figures for the current year. The second column are the projected figures for the following year. So slight increase in cash. They're projecting also an increase in accounts receivable, in inventory, and yes, we were guessing additional equipment, and that is indeed what's looking like it's going to happen. And this is just up to the total assets. The next slide has the remainder of the balance sheet as well. And this is more of a, I kind of prettied up the textbook's presentation of both the income statement and the balance sheet. To me, it's more readable in this kind of approach, but in this presentation, but again, this is what I'm used to in my world. So looks like we've got some additional potential accounts receivable, a little bit more notes payable, but not a whole lot. So it looks like most of the financing possibly for the equipment may have come from cash flows. Okay, so how we come up with these statements is we do come up with a sales revenue or sales ratio. So where we use the sales from the projected year over the sales for the current year. So our example that we had here in the book, our projected year, the sales revenue was 594,000. So that's ST plus one. The T plus one is, if we were using 2022 figures to project 2023 results, 2023 would be ST plus one, 2022 would be S sub T. So 2023's projected sales divided by 2022's actual sales gives us what increase in sales revenue we believe we're going to see in 2023. And this was you subtract 1 from this figure and multiply by 100, so 32% increase in sales. So we can also use that sales ratio to project figures on the income statement and on the balance sheet as well. Okay. So we use the 32% increase to figure what our inventory is going to be on our projected balance sheet and our projected accounts payable. These are just two examples off of the book. And I see that the inventory is actually not exactly that amount. And I'm sure that would have come from a different financial statement. So accounts payable, again, these are just rough estimates. It was 24,749 as the projection. So that's one way we can come up with projections. So owner's equity is basically just kind of a forced result. It's total assets minus total liabilities, the restatement of the accounting equation. And your owner's equity is going to increase by the amount of net income minus any projected dividends too. Okay, so if we use the pro forma balance sheet using the percentage of sales ratio method to project our figures, we're multiplying each line item by 1.32. So that's how 6,600 times 1.32. Is what's going to give us our cash of 8,712. So this is going to be a lot like there's a financial statement assignment for this chapter or project, and it'll be very similar to this. So if we take 6,600 actual figures for the base year, the current year, multiply that by 1.32, the result is 8,712. And there are a few places where it doesn't come out exactly the same. Not sure. But in some places, like fixed assets, we will probably be given what that increase may be. And actually, we did just use the percentage of sales to determine that equipment. Okay. So again, using percentage of sales is how we got the projected figures for our accounts payable, notes payable, salaries payable. And notes payable does show up in two different places in this balance sheet. the current liabilities, this would be the current portion of the notes payable, that part that's due within 1 year. And the long-term notes payable, that would be the portion that's due beyond 1 year. Okay, so projecting a second year, that's where the project picks up. I should change that to week 13 instead of week 12 project. I apologize for that. So we'll project the pro forma balance sheet using the percentage of sales and the pro forma income statement. And that pro forma income statement I will give you figures for any item increases. And so we'll go over that here in a bit. So change in sales and, the needed fund, excuse me. That's page 178, section 9.3, kind of a short. What this is a determination as to whether or not the owner's equity is sufficient to cover our increase in assets. Main question this answers, do we need additional financing? Either in additional owner's equity or do we need to do some borrowing? So break down the equation. NF is the needed fund, and the textbook goes through an example using the projected financial statements versus the financial statements for the current year. So the change in sales is our delta S. So the delta S is going to be the sales from the projected year minus the sales from the current year. So for our example, the projected year sales, again, you need a point of reference. You can go back to page 174. And our sales was the top figure off of table 9.1. 9.1. So 594 were our projected sales revenue for the following year. $450,000 is the current sales revenue. The difference, the increase would be $144,000. That we multiply by our assets minus liabilities. Then from that, we subtract our net profit from the income statement times 1 minus owner's payout, which is the portion of profit the owner takes as earnings. And generally, you would have that figure given to you. It is in this example, there's an assumption that the owner payout is 58% of profit. So I've got the delta S. We multiply that by our assets minus liabilities, and that is the current year assets minus the current year liabilities is where those figures were obtained. So that was like the top of 175, that financial statement using the current year column was where the 116,193 was total assets for our um, 116,193 was total assets for the current year. $87,037 was total liabilities for the current year. So from that, we multiply the difference between assets and liabilities times the increase in sales revenue. Subtract from that the net profit from the current year's financial income statement times 1 minus that owner payout ratio, which was 58%. So 1 minus 0.58 And then again, I missed part of it. We multiply that result also by the sales for the projected year, for the subsequent year. So 72.75 was our net profit times the owner's payout, one minus the owner's payout, and then also times the projected net sales. So what we get in the needed fund is 5,296. And that just tells us that we need an additional 5,296 in financing, either in additional owner contribution or in loan, in the format of loans. Okay. So change in sales. Well, we already did that. Sorry. I think I had the wrong heading here. Oh no, we were actually talking some more about it. So doing a forecast, we're making an informed estimation of a future value. In financial forecasting, we're projecting financial figures for the future state and value of financial and economic variables. So we're trying to take the past and detect a pattern of some sort and use that to project future results of future operations. So what's the importance of financial forecasting? Well, not only to meet the needs of borrowing or to meet the needs of government agencies, it helps managers, probably about more than anything. Helps managers determine not only production capacity, but maybe what kind of order size are we looking for? How many employees do we need? How many shifts do we need these employees to work? What kind of inventory are we looking for? As a minimum. Another big figure is our cash flow, our borrowing needs. And from all this, we can come up with a marketing strategy as well. So there's a lot of importance to doing this financial projection within a company. So the role, what financial forecasting helps the company also kind of get back in line with its mission, something to provide evidence to the investors that yes, we're projecting to make a profit. If you need to make a determination of value of a company, some of this is a little bit repetitive of material we'd already seen. Determining our present and future cash needs, benchmarks too. We can set our benchmarks, and then once we get actual figures in, we can compare those to those budgeted. So, maybe the company's looking to develop an alternative business strategy. We develop financial forecasts relative to that business strategy. The year goes by, we see now, how did we do? The actual versus the projected. How were our variances? Were they favorable? Were they unfavorable? Okay, so our basic steps of forecasting that starts on the top of 180. Actually goes on to about most of 181. So first we determine what questions are we looking to answer? Why are we predicting? Are we looking for cash flow projections? Are we looking for sales projections? And also, how far out are we wanting to go? What's the forecast horizon? Generally, the longer the horizon, the less accurate the forecast. So if you're looking to project financial statements for 10 years, they're probably not, that 10th year is probably not going to be that accurate when it's compared with actual results in the future. things happen in 10 years that you maybe couldn't have predicted would happen. I'm sure if someone were doing, 10-year projections back in 2011, they would never have predicted, the pandemic. Who could have seen that coming? And who could have seen the result, the impact that that had on businesses? And for some businesses, it was a money maker. Amazon. Amazon made out like bandits. Your, DoorDash and places like that did very well. And, you know, Instacart, companies like that did very well, but, your restaurants suffered and a lot of them had to close. So we couldn't have seen that coming because, it's just total disaster that we just, who would have ever predicted it? I've never seen one in our lifetime. So if you're projecting, financial statements for maybe 1 to 2 years, those are going to be a lot more accurate than, your 7, 8, 9, 10 year financial statements. So the determinants of the number of years that you forecast your financial statements based on the product and what its lifespan is, your current and your estimated future product demand, the availability of data, and do we have a strategic plan of a predetermined length? Maybe we've got a 5-year plan in that's being developed. Well, there's your forecast horizon, 5 years, in order to meet the needs of that strategic plan. So the main steps are just selecting a forecasting model, applying that model, testing the model, validation. This is where actual versus projected is going to be key. We get 1 year into a 5-year projection. We're going to stop. We're going to look at the results. We're going to compare those to the actual figures or the projected figures. And we'll see, what worked and what didn't, and where we need to make adjustments. And at that point, if we determine, hey, this model didn't work for us, maybe we'll try another one in order to project, the rest of the plan. So this is right out of the book as well, bottom of 180. This is figure 9.2, the basic steps of forecasting. It's a bit of a decision tree there. So we are, your model choice is going to be determined by your objectives, your forecast horizon, and the variables you have to use. Your data, available data is going to determine your variables. Your model choice, you apply that, test and evaluate the data, validate the data. If needed, modify, validate again. And if we need to do a new model, then we just start all over again, basically. So there's qualitative and quantitative models that are used in forecasting. This is the bottom of 181 all the way through to 184, very top of 184. So the qualitative models, which are known as the judgment models, largely consist of opinions and polls, surveys and market research. Your quantitative models, there are what's called structural versus non-structural models. Qualitative models, I'm not sure if this still happens at the Northwoods Mall anymore, but I know back when I was a lot younger, there was a company that did market research. And quite often, these were usually retired women that were, walking around with a clipboard, and sometimes they'd follow you somewhere and ask if you wanted to answer a survey and would ask your opinion on maybe a new product or something like that. I'm not sure if that company's still in existence now, but that's the kind of information which would be, gleaned from a qualitative model, would be the results of market research. Your opinions, your polls, your surveys, and your market research, based on the results of those models, the company might get an idea of what the potential demand may be for a new product. Well, the demand, that's going to determine other items in the financial statements which are being projected. Your sales determine your cost of goods sold, and maybe we have our other expenses all expressed as a percentage of sales as well. So that at least helps us get a start on projecting and forecasting financial data. So who can be asked for opinions? It can be anybody, with not only within the firm and also outside of the firm as well. So if we have an existing business, we have our executives, our sales staff, our factory employees that we can poll all them. We can also poll individuals outside of the firm. Our customers, they're a great source of data. Matter of fact, I just had to, line up a rental car thanks to my car deciding to take a poop on me on the way here. And I called Enterprise to get a rental car. Guess what? End of the call, I had a survey to complete. So companies are always coming up with, surveys and opinions, and some companies will reward you for doing so. I think like Hardee's, you could get like a free breakfast biscuit, or Dairy Queen, you could get like a free dilly bar for participating in their survey. Something to make it worthwhile. So there's something called the Delphi method also, that's another forecasting model, and this is the basis of our mini research paper. And Delphi methods discussed mainly at the bottom of page 182, a little bit top of 183 as well. So Delphi method, you have a panel of corporate executives and experts, and normally it's done anonymously. So the survey or whatever is going to be free of biases. We're not going to know who's who answered what. So the participants feel freer to be completely honest. And sometimes they generally don't know what company they're giving their opinions for. So a facilitator will send out questionnaires and surveys to participants. They will answer. Then there will be some sort of a compiling of the data from those questionnaires or surveys, and a report would be drafted of the responses. And that may help a company, determine what, like, for example, the demand for their product is going to be. So surveys and market research, some of the more famous surveys are the Census Bureau comes up with the survey of consumers' expenditures. This links right out to the Bureau of Labor Statistics, which is a good place to get a lot of forecasting data. So CE is consumer expenditures. So we've got like some our periods are in either a PDF or Excel format. So multi-year means and variances, percentage. There's a lot of good stuff in here. And there's also, there's, income before. There's a lot of good stuff that can be used for, coming up with, projecting sales for a new company. Excuse me. And there's also the survey of consumer confidence. You've probably heard of the Consumer Confidence Index. That's where this is reported. This conference dashboard.org Oops, pardon the pop-up. So I've got, here's the consumer confidence index in October. It's declined a little bit, probably mainly because of, inflation for one. And they do go into a bit of yeah, they said recession risks appear to be rising still. So should a company expect, a huge boom in sales for the next year? Probably not. Probably not because, consumers are being a little bit leery right now. Okay. So market research would, and this is towards the bottom of 183. Primarily, market research is comprised of questionnaires, field interviews. That's, those little ladies that I was mentioning that used to putter around the Northwoods Mall and get people to answer surveys for them. They would do field interviews. They might have a prototype of a product, and what do you think of this product? Would you buy it? If you were to buy it, how much would you pay for it? They would ask questions like that. Observations, there might be, maybe a prototype of a product again, and you have, a company leaves you in a group or you by yourself alone, in a room, with the product, and you're being observed the whole time. Maybe via camera, maybe, a one-way mirror, something like that. And then focus groups could be used as well. And that's used to form predictions. So your market research can be a pretty valuable tool. Excuse me. So our quantitative model, just on the bottom of 183, up to the top of, well, really just the bottom of 183. So mainly our quantitative models, you're going to use historical data in order to potentially predict the future. And you'd be describing trends, describing and explaining any trends and any changes that those trends have to our financial statements. So there are two quantitative models, which are discussed on the top of 184, and then structural versus non-structural models. And see, our structural models, those are going to focus on, coming up with some sort of a dependent-independent relationship between variables. And so variations in independent causes cause variations in what dependent variable, and kind of the X and the Y, so to speak. And okay. And then our non-structural models that we won't go into in any detail, there are patterns of change in variables over time. There's what's called the time series models and barometric models. We won't go into any of those in detail. So that was actually the end of where we're doing our material. So we did not cover our chapters, or sorry, section 7 or 8 or 9. That was kind of a lot of overkill. Actually, there was a lot more material in that chapter, and it just really kind of defeated the purpose of really what we need to get into for our purposes here. So the mini research paper, one of the discussion questions, Doctor, and that is, discussion of the benefits of the Delphi method and what might be the limitations of the Delphi method as well. So 1 to 2 pages as usual. Oh, this is one I did not use a discussion question. I couldn't remember. It's been a while. It's been a while since I wrote this. So the benefits, the limitations of the Delphi method book could be used as one source. You definitely need at least another source here because the textbook was pretty sparse in its discussion of the Delphi method. Okay, so and then our week 13 project, we'll talk about that here in a little more detail. So we're following the examples from tables 9.1 to 9.3 on 174 to 177. I've given you some additional data for inputs, and I have the base year given to you as well. So there is I'm going to come out to this and go into here. And let's go back out into week 13. Boop, boop, boop. I did not mean to do that. Let's just save here. Okay. Oops, what did I do? Ugh. Week 13. This is not my day. Okay, so our performance statements project, the actual, the data. This is the Word document. So this is our projected increase in year 1, and then from year 1 to year 2. So we're given our actual figures for the current year. We're going to project 2 years. So we're going to project, if this is 2022, we'll project 2023 and 2024. So for sale, one column is for the one tab of the template, and this is our template right here. This is what you see when you open up the template. So you have a pro forma income statement in one tab and a pro forma balance sheet in the other. So if I were to project sales revenue for year 2, my projected increase for projected year 1 is 40%. So I would take the current sales revenue and multiply that by 140%. For year 2, the projection, the increase was only going to be 25% from year 1. So I would take that, whoops. That's me using I hit the backspace instead of, yeah. So that'd be our projection for year 2. So we would do that for sales revenue, cost of production. Our operating expenses are not increasing by 40 and 25%. So the increases are what's given here. And this is on the first page of the Word document, but the only page of the Word document. So these are our projected increases for each of our expense items. For salaries, for rent, utilities, equipment, insurance, depreciation. We have projected increases for all those. Our total operating expenses will be in the sum total of, again, all the operating expenses. Earnings before interest and taxes will be gross profit minus operating expenses. Interest expense, the projection there is given in our data, as is our projected increase for income taxes. So net profit will be net profit before taxes minus income taxes. And the formulas are, I think, all available in that first. I'm not going to save that. You make sure you have something where make sure I didn't hide the formulas in your template. I don't believe I did. Open your actual template. Hopefully it doesn't give me grief. Nope, you can see. Yeah, you can see the formulas. So if you want gross profit formula, hey, you can just copy this one and paste it over into the adjacent cells. For gross profit formula, for the operating expenses total to total net profit before taxes and to calculate net profit. And again, interest expense, you'll want to put that in a negative figure with a minus sign in front of it. So the next column over is our pro forma balance sheet to be projected using the percent of sales method. So to get that, we'll need to create determine a sales ratio for both year one and year two. I wish I wouldn't have deleted that now. Now of course it's going to give me grief about that. But, let me just bring it back up. Okay, so I did have that. So my projected sales revenue for year one divided by the actual figures for year two, I've got a 40% increase. So I would take that 40% increase, and that's how I would determine my balance sheet figures for projected year one. I would do the same thing for year two to come up with that projection as well. Okay, so that's the project. And let's talk about what's all doing stuff there. So that would be due, and that's going to be, our financial statements. That's, our pro forma statements. The financial statements project, that's a different thing. That's what's replacing the QuickBooks project. We'll talk about that next week. So what we cover next week, next Monday, hopefully I'll have a functioning car by then. If not, I'll have a rental car still. But we'll cover all of chapter 17, which talks about some, topics kind of similar to this. We talk about budgeting. So that's kind of a complementary topic to what we started here in the pro forma statements. So operations, budgeting, and taxes, we've already in the early weeks covered a couple of sections from chapter 17. We'll cover the whole chapter next time, and it's not a very big one. So this financial statements project, formerly the QuickBooks project, we'll discuss that next week as well. So what'll be due next week would be that mini research paper on the Delphi method, the project on the pro forma statements, and there's a quiz covering chapters 5 and 9, which I believe is all of 10 questions. And that's where we'll pick up next time. Okay, so did we have any questions on any of this? See if there's anything in the chat window. No. So I do have the recording on. So once I get this closed and the recording processed, and I can get the MP4, I'll get that loaded into up into YouTube, and I will add a link into our week. Probably, where am I going to enter this? Sorry. Probably somewhere around the top of our material. So let's say our link, I'll probably put maybe right after the overview. I'll have like a, YouTube link to the 11/21/2022 class. And then that can be revisited. So, is there any questions on anything? Well, I guess it was a short one for y'all. Again, I do apologize for the very last minute cancellation of the physical class, but my car was just not going any farther than it did. This is when I'm lucky to have a plug-in hybrid. My gas engine stopped working, but my electric engine kept working, but just at a reduced capacity. And I was able to get here to my home and thought, well, I better just conduct class this way because I can't get a rental car until tomorrow morning. So I hope everyone has a good holiday. Travel safely to those of you who are getting out of town, and hope you have a good time with family and friends, and we will see you next Monday. Oh, got a chat question. Oh, thank you.
Thank you so much. Have a great break.
You too. Have a great break.
Take care.
Bye.